Welcome back to FX Talk, an eBreed podcast all about the foreign exchange market. I'm joined as usual by Enrique and Roman. And in this week's episode, we discuss the fallout from Fed Chair Powell's comments at the annual Jackson Hole conference last week. Is a September rate cut now a done deal? And is the Federal Reserve's independence being compromised? I will also dissect the August PMIs out of the euro area and give our thoughts on what's next for the Bank of England following last week's alarming UK inflation numbers. But first, let's start by talking about the latest news and developments we've seen in the FX market in the past few weeks. I guess the main story has been that markets are now almost fully pricing in a September rate cut from the Federal Reserve. That follows some weak data out of the US labour market that has shown that hiring almost completely ground to a halt in the last 3 months amid possible demand weaknesses due to the tariffs, but also possible supply shortages. That's in part due to President Trump's crackdown on immigration. We also had some surprisingly dovish remarks from Chair Powell at the annual get-together of central bankers in Jackson Hole, Wyoming last week. More on that very shortly. This is acted to keep pressure on the US dollar. The US dollar index is trading around about 2% lower since the start of the month as a result. In the euro area, the release of some encouraging PMI figures has raised optimism over the state of the economic recovery there, and euro dollar briefly rose back above the 117 level last week. Meanwhile, the latest data out of Britain suggests that the UK remains stuck in stagflation, whereby we have a period of rising inflation on the one hand and a sharp slowdown in the jobs market on the other. Sterling, though, has remained well bid and has been one of the better performers in the G10 in the past month, as markets doubt whether the Bank of England will cut interest rates again in 2025. But let's dive into what these headlines really mean for markets and currencies in particular, with our main segment, the Market Pulse. I want to start by talking about Jerome Powell's comments at the Jackson Hole conference last week. As I mentioned, Powell struck a pretty dovish note. He warned over the state of the US jobs market, said that inflation impacts of the tariffs would be temporary. And he also very explicitly hinted that the September rate cut could be on the way, as he said that the shifting of the balance of risks may warrant an adjustment in the Fed's stance. So all very dovish. The dollar sold off quite sharply. In fact, on Friday, it was down around about 1% against its major peers as markets raced to price in a September rate cut from the Fed. Let's turn to you, Enrique, first. What are your key takeaways, first of all, from Powell's comments last week?
I mean, I think that it's hard to see that significant change in tone from the very relatively hawkish minutes of the previous meeting to that, like you said, very dovish speech, without suspecting that the relentless political pressure from the Trump White House has something to do with it. I think that we saw yesterday the next step in which Lisa Cook, a Fed governor, was fired by Trump. It's not clear what the next steps legally will be because apparently Ms. Cook refuses to step down. But it is very hard not to suspect that had there not been this political pressure, we would not have seen this dovish tone from Powell. Again, you could justify perhaps the stance that he took on Jackson Hole by itself, but the sudden shift based on no more than a single labor market report, admittedly poor one, is very unusual in the Fed. And I think we've had this discussion. I think Roman disagrees, but it's hard to resist the conclusion that the political pressure is getting to the Fed, and the Fed independence is increasingly compromised.
There is a problem with regards to institutions in the US. I think that the quality and the security of institutions is certainly under threat from Trump administration. But to say that the Fed is now doing what is dictated by Trump, or that his influence is as significant to actually cause Powell to and the team to lower rates, I think it would be an overstatement. Looking at the labor market data, first of all, labor market is a lagging indicator normally. So this is something that happens after everything else played out in the economy. And if we are seeing some signs, and the latest non-farm payroll report suggested that in recent months, because the biggest problem in the report was the revision to the 2 months before. If we consider that, then there has been a shift in the labor market that was concerning. And if we look broadly at economic data, there is some justification to the thesis that activity may not be as strong in the future. And if that is the case, then I think that easing monetary policy is a reasonable takeaway. So I don't think that...
I want to,
Yeah.
I agree with you that a standalone dovish speech on Jackson Hole could be justified on macroeconomic grounds. What I think that hints at the political pressure having an impact is the significant shift from the previous communications based on a single labor market report, especially when we've seen significant revisions to the data in the past. Again, that it seems to me, if you do not take into account the political pressure, you would not have seen this massive shift from the previous stance to this one based on a single report.
Yeah, but we have to consider two things. The first thing is that if you look at the pattern of revisions, the pattern was typically negative. So in general, it turned out that the the labor market situation was not as good as indicated in the previous reports. And there's an argument to be made here. We have seen some weakness in the labor market in other reports, perhaps not as striking as the latest non-farm payroll data, but also Jackson Hole, since the financial crisis, it was used to deliver pivots, significant messages, etc., on a number of occasions. So perhaps this was just a good moment to do that.
Okay, let me just add something in support of my view, which I understand yours is defensible as well. But the reason why I think that the market agrees with my view more than yours is that the critical 30-year long-term rates in the U.S., which normally would rally hard as a result of this dovish shift in the Fed stance, are actually slightly higher now than they were before the speech. So I think that the most important judge of all, which is the U.S. long-term bond market, is leaning towards my view more than yours, I think.
Definitely, there is some concern about the long-term inflationary situation, and that this is being reflected, but also like trying to dissect this longer-term yields into what particularly is leading to them being elevated is also not that easy. So yeah, perhaps there is some truth to that, and I definitely am concerned with what Trump is doing to American institutions. I think that this is something that probably will be one of the key things that we'll watch in the coming months and quarters.
Yes, I mean, look, it was a complicated scenario, isn't it? I mean, we went into the Jackson Hole conference. I think there's two things really we were looking out for. Is first of all, it's the Fed's view on inflation, and Powell made it pretty clear he thinks that the tariff pass through to prices will be temporary. And then on the one hand, there's this big debate surrounding the labor market. You mentioned, Roman, the data out of the labor market has deteriorated. That's pretty crystal clear. I think the big argument on that is to what extent is that due to weaknesses in demand, or what is it due to supply? Because if it's issues with supply, actually the Federal Reserve can't really do much about. And if you look at the data, I would suggest it is more of a supply problem. Jobless claims in particular are very low. So it would suggest that we're not seeing mass layoffs necessarily, but hiring is weak. And now that could be a situation whereby businesses are, say, instead of laying off their staff, maybe they're just putting in place hiring freezes. That's very possible. But also, I think there's this argument surrounding Trump's crackdown on immigration. The fact that we've had mass deportations, we've seen a significant drop in immigration levels into the US. I think that's in large part while we're seeing such weak non-farm payrolls numbers. I think that's played a huge role in recent data. My expectation going into last week's Jackson Hole conference was that Powell wouldn't sound so dovish on the labour market. My view was that the Fed would believe this was more a supply problem, and maybe that they'd be more concerned on inflation. The fact that Powell's not concerned on this inflation spike by the looks of it, and they are concerned about the labour market. Two pretty dovish changes in rhetoric for me, and I was caught by surprise. I've got to be honest. Basically, seems to confirm that the Fed's ready to cut rates in September, which I didn't think that Powell would be so explicit about. I must be honest. In terms of the September meeting, what do you guys think? I mean, is a rate cut a done deal, and what does the Fed do then? Do we think they'll signal a couple more cuts this year, or certainly one more? What do you think?
We'll still have one or two more inflation. Well, we have the July PCE, which there's not a lot of room for surprise because we already had the CPI earlier in the month. There's one more inflation data point, and there's one more job market data point. I think that the threshold for a positive surprise, upward surprise in these data points is very high before we see the Fed backing from the cut. So I think that a cut in September is a done deal. Unfortunately, I don't think at this point the situation warrants it. I think that the messaging for further cuts beyond September will be very highly dependent on these two data points: the jobs market data point next week and inflation 2 weeks later. I think is going to be very difficult for the Fed to not cut, not just in September, but in the coming months. I think that the situation in the U.S. is extremely worrisome. It's of the G10, of all G10 countries, is the one where central bank independence has come into sharper question. And I like I said, I pay attention almost obsessively to the 30-year bond, because that is delivering the market verdict on what the Fed is doing and what Trump is doing. But to summarize, yes, I think that's a done deal. I don't think the Fed can afford to back down from a cut in September. The loss of credibility will be greater.
Agree. I mean, it seems pretty baked in. Markets, I haven't checked this morning, but I think we're looking at around about 90%.
Still at 90%.
85, something like that.
85, 90, yeah. And it's very rare that we get a situation whereby a central bank sort of changes its guidance to basically confirm a cut at the next meeting and then changes its mind. I mean, that doesn't happen. I mean, I think this is pretty much a done deal. I'd be very surprised we don't get September cut, even if the data does surprise expectations. Roman, do you agree? And what do you think? We see a couple of cuts this year, do you think?
I think 100% we are going to see a September cut. I think probably 2 cuts this year would make sense. One right now and one in December. But also what I would be interested to see are the forecasts, what the members are actually thinking about the economy, about the labor market, whether the messaging that Powell sent will be confirmed by this, and to what extent. And this is something that I think will be most closely watched, and the dollar probably will take a lot from that. And yeah, that would be my view.
Yeah, I think that's going to be key. I think we've got the latest dot plot in September. Correct me if I'm wrong, but yeah, that's going to be very important for markets. Not just if we get, say, a December cut, but what are the Fed going to do next year? That's going to be very important for markets in the next few weeks or so.
Plus the race, in the Fed, because I think that the names keep coming for who could be the Fed's next chair. And the probabilities keep changing. So it's something that markets will be looking with an increasing scrutiny, probably.
Absolutely. I think that's going to be the key factor for between now and the end of the year, at least, is Fed rates, and then who's going to be the next chair of the Fed, and concerns around independence there. I think everything seems to revolve around the Federal Reserve at the moment. Great. Let's move on, and we want to talk about last week's PMI figures out of the Eurozone, which showed a few green shoots of recovery. The composite PMI, which is a weighted average of activity in services and manufacturing, that jumped to the level of 51.1 in August. That was well above expectations and the highest level in over a year. Roman, let's start with you. What does the data tell us, do you think? Why are we seeing this solid sign of a rebound out of the Eurozone? What do you think?
So for a while, we have seen quite a significant divergence between what's happening in the services sector, which was doing relatively okay, and the manufacturing sector, which was doing very poorly. And right now, we have seen some recovery in manufacturing sector, which is very welcome and long overdue. And this is something that is being led by Germany, which is particularly welcome, and also is kind of in line with what we have been expecting, considering that the German fiscal package was passed. We are expecting some growth stemming from that, and it seems that some optimism could already be impacting the sentiment there. But also we have seen situation in France seemingly stabilizing. So I would say that the data is quite encouraging right now. Obviously, we are only talking about the economy barely growing at those levels because the PMI, the composite, is around 51 basis points. This is certainly not much, but hopefully this will be a prelude to a stronger growth in the coming months and quarters, and this is certainly something that we are expecting in 2026.
Well, I guess probably the biggest news we've seen in the last few weeks, at least, has been this US-EU trade deal. And I think that presents somewhat a little bit of a double-edged sword, which I think we've talked about in previous episodes, whereby the deal provides some certainty, 15% tariffs on most goods. It means that businesses can plan ahead, which is a positive. It should be good news for economic activity. But then you've got sort of on the other hand, actually 15% tariffs are still pretty hefty and certainly much higher than what we saw before Trump 2.0. Do you think we're seeing any impact on the data yet? And what do you think of the next sort of couple of months? Do you think we'll start seeing some sort of pass through from this deal to data out of the Eurozone?
Sorry, go ahead, Roman.
No, there definitely is some mild impact, but I would still say that the data is quite resilient and is, for the most part, encouraging. Looking at the mess that has happened in Switzerland with Trump just putting 39% tariffs on things like watches, machinery, and a number of other things, and the fact that the Swiss government is scrambling to get the US on board to negotiate and to maybe limit the economic impact. The fact that we avoided that in the Eurozone, I think it's something that further confirms that it was a good decision. I wouldn't say that the uncertainty disappeared entirely. Obviously, it's Trump, so next week he can just state something and we could again be in a state of disarray. But for now, I think that this is a better of two evils, and the data seems to be, at least for now, supporting that this was a relatively good decision.
And I do think that, I mean, the stagflationary theme that we're seeing throughout the advanced economies also applies to the Eurozone. Granted, inflation is maybe 1% below the US and 2% below the levels in the UK, but still, we have core inflation above 2%, not worrisome levels, but still not below target either, combined with months, quarter after quarter of less than 1% growth. That's overall what we have is a mildly stagflationary environment, where labor market seems resilient, but at the same time, production does not seem to increase. I think that the data points, the problem with the Eurozone is that the data is always a lag. And the first half of the year has been completely distorted by exports to the U.S. and manufacturing to the export to the U.S. getting ahead of the tariffs. So you had a bump in the first quarter, and then you paid the price in the second quarter. I think that the third quarter, now that we have a stable new trade regime, The third quarter will be very important. Will give us a true read of what the European economy is. Unfortunately, we won't be seeing those data points until late September, early October at the earliest. But I think that this stagflationary thing applies to the Eurozone, as it certainly does to the UK and the US.
Very quickly, I know there's obviously been a lot of headlines re-emerging surrounding the war in Ukraine as well, and there was a degree of optimism about a possibility of a peace deal or a ceasefire. Talks between Trump and Putin could have gone better, but also they could have gone a lot worse. But that optimism seems to have faded a little bit. Roman, very quickly, because we're pressed a little bit for time. But where do we stand? Possible peace deal in Ukraine, and what are the implications for the euro?
So we are effectively back to square one. I don't think that the Putin-Trump meeting changed really anything, except for giving Putin some tools to use for domestic propaganda. Russia has not changed its objectives in Ukraine, and it's unwilling to pursue peace. And in this context, I don't have any positive news. And we have seen souring in sentiments looking at the Ukrainian dollar bonds. Prices have fallen. Looking at poly market, odds of a ceasefire also declined, although the liquidity there is quite thin. We have also, I think, have seen some impact in the CE currencies. So yes, effectively, we are back to square one, and it doesn't seem that any agreement is possible in the near term.
That changes very soon. Let's move on. I want to talk about sterling, which, as I mentioned, have actually performed pretty well since our last podcast episode. I believe it was 4 weeks ago since we last recorded one of these. And in that time, the pound has been just about the best performer in the G10. The big news last week was the release of the latest UK inflation figures, which once again surprised to the upside. Inflation in July rose to 3.8%. As not only the highest level since January 2024, but is almost double the Bank of England's 2% target. While the core rate also crept up again. That's up to 3.8% as well, which is the highest level since April. It's a bit of a worrying trend, this. I mean, it's likely to continue to squeeze households at a time that's pretty tough. I mean, we've seen the data out of the UK jobs market of late has been fairly diabolical. Jobs are being shed at just about the fastest pace on record, at least since 2014, outside of the pandemic period. Unemployment's going up, wages are coming down a little bit. The growth implications are not particularly encouraging from either the inflation increase and the deterioration of the jobs market. And the big worry, I think for everyone, is that we get a scenario whereby the Labour government are effectively forced into hiking taxes again in the autumn, and that leads to this downward growth spiral. Should be negative for the pound, but as I said, it's been one of the better performers. I think that's largely due to expectations for Bank of England policy. It is looking increasingly likely now. At least our base case is that the MPC holds rates steady throughout the rest of this year. I think markets are pretty much in agreement. I think there's only around about 10 basis points of cuts priced in this year. And possibly we may be very close to the end of the easing cycle. I think there's only probably about 25, maybe at top 30 basis points of cuts priced in the next year or so. So that seems to be providing sterling with a bit of a support. And the pound, as I said, seems to be holding up quite well against most of its peers, despite these downside risks. What do you guys think? Do you have any thoughts on this? Do you think the pound could continue to hold its own despite worrying data that we've seen in the last few weeks?
I think we're going back to some version of the 1970s with this stagflationary themes where inflation continues to remain stubbornly high, even as GDP stagnates or grows very little, but labor markets remain resilient, and there's neither job creation nor a serious uptick in unemployment. I mean, I think that we the lack of reaction in sterling to the higher rates and to growing rates differentials between sterling and the Eurozone on the one hand and the US on the other tells us that maybe we've reached the limit to how much sterling can strengthen based only on rates and the Bank of England willingness to continue to fight inflation. I think we need to see some good news in the economic front, some acceleration of growth before we see further gains in the pound. It's going to be very difficult to continue to see appreciation on the pound based on inflation coming up higher than expected.
For me, UK is one of the two economies in the G10 that are concerning, particularly concerning, next to the US. And the data has been very problematic. The Bank of England is in a especially tough spot right now. But I also think that one big problem is the political situation. And it seems that what's going on with the long end of the curve in Britain, the fact that the yields have increased quite considerably, is in a way a vote of no confidence in the British government. And as long as those things continues without being resolved, as long as there is no remedy politically, I think perhaps there is some downside for the sterling.
Completely agree. That was going to be my wrap-up point. Actually, it was that the interesting trend that we're seeing, whereby gilt yields in the UK continue to climb despite the Bank of England cutting interest rates. Whenever we see that, that's generally a pretty stark warning sign. And yeah, to me, suggests that the markets are very much losing confidence in UK assets. They're worried about the state of public finances. And all of that does, it tees up what was likely to be a very interesting autumn budget. These budgets tend to be overlooked by currency markets, but I think this one is going to be another blockbuster, and it's going to be a very important one for sterling, that's for sure. Great. I think we'll wrap things up there then. So thank you all very much for listening and for watching, and we'll catch you on the next episode.
Thank you.
Thank you.